Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're breaking down the new monthly income kings, also known as the M9 ETF lineup. If you're looking for monthly income, stability, and strategies that retirees can count on, this is the presentation for you. Before we dive into this, I got to do a shout out to all of our Patreon supporters, all of our YouTube subscribers, and most importantly, our YouTube members. If you're not a member of the supporting the channel, you can do it for as little as 99 cents. But also, you can also join Patreon and get a lot more information behind the scenes. If you're not a member at all, don't be afraid to hit that subscribe button, hit that bell notification. You don't want to miss a single one of our episodes. Let's dive into today's video of the new monthly income kings. Before we get started, I want to take a moment to give you an important standard disclaimer. Past performances do not guarantee future results. This presentation is for educational and informational purposes only. None of this should be considered financial advice. Everyone's situation is different. Always talk to a licensed financial professional before making any financial decisions. I am not a financial advisor. All right, now let's get into the fun part. So the question really comes into is what are M9 monthly income ETFs? Think about M9 ETFs as your monthly cash flow toolkit. These funds are designed to provide stable and reliable monthly income, which is exactly what retirees are looking for. They offer monthly dividends, option-based income strategies, high potential income, and exposure to strong index and large cap assets. The reason why retirees love these funds is simple. They create a very potential, predictable cash flow that you can actually budget around. So the core strategies of the M9 ETFs is to deliver the level of potential consistent income. M9 ETFs use several different option-based strategies. Now, these strategies are like covered calls, which sells calls on the positions they already own, cash secure puts, collecting premiums with cash ready to buy, option premium harvesting, continuously selling options for income, leverage-based approaches, using controlled leverage to boost their returns, and sometimes return of capital of ROC, which you'll want to monitor because it affects the NAV over time, but it also gives you some tax advantages. These strategies are the engine that power the income of these ETFs. The JP Morgan Powerhouse, JEPQ and JEPI. Now we're moving into some heavy hitters. So let's start off with JEPQ. JEPQ is what I like to call the dependable workhorse. It invests in the NASDAQ 100, but uses a disciplined option overlay to smooth volatility and preserve NAV. The key strengths: very strong NAV stability, reliable distributions, and a disciplined rules-based strategy. And the yield-wise, it usually falls between 8 and 11%, and you can see that the current yield is right inside that range. This is one of the most confident picks for retirees. Look at the performance. Even with the massive drop-off of April 2nd, it's recovered and give you a 2.09% growth in this year. When you look at the historical part, same thing. Fits very, very well within the historical numbers that we're talking about, even though historical numbers can change with no, with no notice and no nothing. You can change, and this one holds. That's what makes the JP Morgan powerhouses so strong. It gives you the JEPQ reliability and stability, gives you some higher yields. And then we'll talk next, the JEPI market leadership. Next is JPEI, one of the most popular ETF funds in the entire country with over $30 billion. That's right, $30 billion in assets. JEPI invests in large cap S&P 500 stocks and adds an option overlay for income. Its strengths include low volatility, a historical smooth NAV, and a reputation for reliability. Now, typically this yield is between 7 and 9%, and the current yield right now is definitely in that range, and has become a core holding in many income-focused investors. When you look at the track history, since that April 2nd again, it's come out and it's been stable. It's only down 5.03% in the 1 year. Again, that can change on a regular basis. And the overall inception, the overall timing of history shows to be some solid hardcore numbers, pretty much in the same range that we've been talking about. Now, all these numbers can change as the market changes, and the market changes flexibility. QVDO, and this is the Amplified NASDAQ 100 Enhanced Yield Fund. Now, QVDO runs that enhanced NASDAQ income strategy it's known for. It has high monthly payouts, strong option premium capture, and better NAV stability than many high-yield peers. The average range is in that 10 to 12%. Now, currently it is below that typical yield at 9.65. As you can see, things do change. They're always changing hourly, daily, all by the stock market. It's one of the most well-balanced monthly ETFs heading into the 2025 and 2026 years. You look at the performance since the April 2nd drop-off, it's dramatically climbed right back out of that hole, back up to a 9.23% growth over the past 12 months. And when you take a look at the historical numbers down below, you see it runs between that 17 and 22%. Now, those are historical, and they are always differ. They will differ as we age and as things change. So remember, none of this is guaranteed. None of this is established. It's just hardcore numbers at the time of the video. QDV. Now let's move into some creative options in our M9 group. And that's going to be what we call our unique players, SPYI and EGGY. So the first one up is going to be SPYI. It's part SP 500 exposure and part tax efficient option overlay. The goals are strong income, lower taxes, and balanced total return. This is a great hybrid fund because it blends growth with monthly income. When we take a look at the estimate, between 8 to 12% is a typical yield, which the current dividend is 11.91 as the time of this video, which of course is always willing to change. So it falls right into that area of that typical yield. When you take a look at the performance of the fund, you can see the drop off of April 2nd has recovered very, very well and is only down 0.83% at the time of this video. When you look at the overall of the inception side of it, that's a historical blend that you currently use. And SPYI shows that it gives a solid return. Now, those numbers can change. I have to completely say this. All those numbers can change. They're just snapshots at the day of taking of this video. Now we have EGGY EGGY. That's the newcomer. This is not over a year old yet, but it's been a dominant force coming out as one of the new ETFs. EGGY uses a multi-layer income strategy, meaning it pulls income from different assets and different type of options. Some of its benefits include income diversification, lower NAV volatility, transparent option strategy, and yields often are between 12 and 20% range. Now, of course, those will always differ. They will always be changing as the stock market changes by the minute, by the hour, by the day. You can see the current dividend yield is 22.48% paying out monthly. Again, I have to clarify that can change. That's just a snapshot of when we took this video. You look at the historical pattern, everything is dropped off April 2nd. It came back very strong, but in today's market, it's having a little bit of a downslide. So you have a year-to-date loss of 8.06%. When you look at from the inception side of it, you're looking at this with a 15.76%. Now, this is historical numbers only, as they will differ, they will change. So just another snapshot. So now let's take a look right now at the QYLD. And when you look at the fund, it's down 4.20%. Most of that comes from the April 2nd drop off. Now, this is not really NAV erosion, but this is just not recovery. Now, the fund overall gives you that basically that the 7 to 8% historical return. So the historical average is 7.99% annually, though future results can differ across the board. But that's why I say you have that pretty much that 7 to 8% category currently across there. The current yield right now is 12.575% on QYLD. And you can see the assets under management are 7.94 million or billion. Now we go over to the Russell 2000, the Global X Fund. This is RYLD. Now everything stays the same, as all of the Global X funds operate the exact same way, except that they use the Russell 2000 on this one being different. So they're using the same strategy, they're doing the same, and you get about the same results across the board. Now this one's down 8.90%. Since the April 2nd drop off. So it didn't recover as well as we would expect. But they're holding in the right direction, and they're holding that $15 price point. When you look at the return versus inception, this is where it struggles a little bit. You can see that the historical average of this one is about 4% annually, though future results can differ. But they have a nice dividend yield of 12.37%. This is where we talk about the growth and the growth loss affecting the total return. And then our final one is the XYLD, which is the S&P 500. Same story, same results. You're getting between that 7 to 8% return across the board. You've had a negative 5.06%, which primarily was all from that April 2nd drop off. So it really has not recovered 100%, and has a 12.83 monthly, or excuse me, 12.83 dividend yield with 3.01% billion of assets under management. So one of the situations that we run into with the Global X, they have that typical high yield, 10 to 12%. They use that simple covered strategy, and they have that monthly payout. But the trade-offs is, they call this the NAV erosion. It's really price sensitivity. It's the market changes that are going on. They use a high ROC, which is that return of capital, as their tax advantage. And their simple strategy is less flexible. So we do give these honorable mentions, but they just did not make our cut for building our proper retirement portfolio using the M9 strategy. So let's take a look at the M9 ETF performance scorecard. When we first look at the 5 funds that really made the cut, the JEPQ, the QDVO, QQQI, SPYI, and JEPI. QQI got the top along with QDVO for strength of income. They get a 9 out of 10. Then SPYI, and then JEP, then the JP Morgans come in at 7. NAV stability. Right now in today's market, NAV stability is very, very critical and very important. And the JP Morgans win that one, getting 9s out of 10s, with SPYI and QDVO getting a solid 8s, and QQQI a 7. Now the ROC risk. Now, this one, I know always it threw me when I first put this together, and basically is what is percentage between 1 and 10 is the likelihood that they'll use ROC. And you can see JEPI and JEPQ both hit that 9, the 9 out of 10. SPYI got 8, and then the Qs got 7. Now, is that a good thing or a bad thing? Well, this is partially how they use a little bit of their tax advantages versus, like SPYI uses also the 1256 contracts. And all of this is helping you trying to develop a better tax advantage down the road. Now, negative things, if markets really change and things do go bad in a particular fund, they could actually return your funds back to you. So it's always a warning sign. It's always a danger that's out there. But here's the last one that really adds to the mix, the long-term reliability. JP Morgan has established themselves as the kings at rating themselves at 9s across the board. SPYI and QDVO both come in at 8, and QQQI comes in at solid 7. Basically, it says here in long-term reliability, these 5 funds are have that potential for that long-term reliability. They have the potential of that NAV stability. They do show some great potential of income strengths, and they also have the potential of giving you that tax advantage across the board. So with that information, our top winners are going to be JEPQ for that safe balance, the disciplined equity premium strategy, the strong NAV stability, and the reliable income stream of that 8 to 11%. QDVO is a high yield performer, high monthly payouts, strong option premium capture, better NAV stability, and the yield of 10 to 12%. And SPYI is our tax efficiency hybrid winner. Now we're adding also in that I believe made our top 5, which is going to be QQQI for the dynamic yield generator, and EGGY for the diversified newcomer and new ideas in the marketplace. These 5 come together to form a very powerful monthly income core. So when I take and put this into a balanced portfolio, I get a balanced strategy, equity premium strategy, and a strong NAV stability, potential reliable income streams, and yields between 8 and 11%. So how I personally would do it in my portfolio, because I currently own each and every one of these, and they're in my core portfolio. And I put it in exactly this way. JEPQ would be at 25% of my investment. QDVO is 25% of my investment. SPYI is 20%. QQQI at 20%. And EGGY is at 10%. So you can see I have a fairly smooth, diversified pie across the board. The potential yield on this is 12.45%, paying out monthly. The potential growth is about 4.7%, and the potential total return is 17.15%. Now, these are only illustrative estimates based on current yield ranges and historical trends. They're not guaranteed of future performance. This is why my M9 lineup is being so popular. Income plus growth, not one or the other. So building your monthly income strategy comes from a just takes time, it takes research and work. So how do you build your own monthly income plan? Well, here are some key steps for it. Balance the portfolio. Pick the 3 to 5 M9 ETFs. Match the risk to your comfort level. Plan your retirement withdrawals carefully. And review and rebalance as the market change. Remember, the best ETF strategy is one that fits your goals, your time horizons, and your risk tolerances. And most importantly, always contact a professional. You know, it's funny how people always are afraid that they're going to have to pay to have a professional look over their portfolio. I have been contacted this week alone by Charles Schwab and by Fidelity both. They both, because of our fund, they are offering free evaluation of our portfolios. So ask your provider, ask your broker, do they offer that? And take up on a free package for them to look over your portfolio and evaluate where you're sitting. I find many of those are very straightforward and honest. They are not trying to sell you something. It's a free service that they offer.
Thank you for watching. Press the like button